The auto business is a very difficult business, and investors are finding that out the hard way with Stellantis. The company appeared to be a value stock even just 6 or 9 months ago, but shares are down 57% from their high in March this year. And their CEO just resigned after a terrible quarter. The trends are just absolutely awful for the entire company. Now, what we've seen in the auto industry over the last few years is there was generally a massive shortage during the pandemic. This was a global phenomenon. Really, the only company that was growing at that period of time was Tesla, because Tesla didn't pull back on their orders, particularly for chips, but there were plenty of other parts that were in shortage as well. As that shortage ended, there was excess demand in the market as supply started to increase. So the financials of a lot of these companies started to look better and better in 2023 in particular, and even into earlier this year, because prices were still high, margins were really high, and inventory was still short in a lot of places. But as the year has gone on, inventory has become less and less of a problem. Pricing has been challenged because there's been excess supply in the market, and companies that don't manage their supply and demand correctly are really facing a lot of problems. Stellantis is really one of the companies that's facing this. Volkswagen would be the other one to keep an eye on. But I think the challenges are much bigger than just what the CEO had going on. It's the entire way this business was built. I'm going to get to some of that confusion and why the numbers are so bad for Stellantis, and why General Motors, the company that I do own, is doing relatively well. Get to some of those details in just a second. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's look at the trends for Stellantis, because these are about as bad as they get. The first one I'm going to show is just the sales trends, and these are trailing 12-month numbers starting in the second quarter of 2023. And this is just starting at zero. What is the percent change in revenue from each of these four companies? Stellantis is in blue, Ford in orange, GM in purple, and Tesla is in the greenish color. So you can see that Ford and GM are actually the fastest growing company out of these four. Tesla is a little bit behind, basically flat in their revenue since 5 quarters ago. But Stellantis, look at that trend, going negative in the first and second quarter of this year. Now that chart doesn't include third quarter numbers. These are the third quarter numbers. Net revenue was down 27% compared to a year ago. There was lower shipments, there was unfavorable mix, but there's not really any way to wave away a 27% decline. On a unit basis, there was a 20% decline in the number of units sold, and inventory was down, but there was still more than a quarter's worth of inventory on the balance sheet. US dealers in particular have a lot of inventory. The reason that you want to look at inventory from automakers is that's going to tell you how much pricing power there is in the market. If you are a buyer, you go into a showroom and you're the only person there, and there's 150 cars on the lot, you got a lot of power as a buyer. You can basically name your price. If you go in and there's 20 other buyers and there's only 10 vehicles on the lot. That was the case during a lot of the pandemic, 2021, parts of 2022. That was when those dealerships had a ton of power. Dealers were taking a huge cut and raising their prices along with automakers. They were generating really good margins as well. Didn't have to discount vehicles at that period of time. Now, to make matters worse, it has been buying back stock at an incredible rate. 7.7 billion euros returned to shareholders in 2024, but this buyback program was completed in October. The stock is down considerably since then. So management is just making all kinds of mistakes all across the board. We could look at this a number of different ways, but I think the easiest way to understand why Stellantis is doing so poorly is they have no leverage in their business. This is the brands that Stellantis sells. So depending on where you live in the world, you may see a number of these different brands. I'm in the US, so we see some Chryslers, we see some Dodge. Jeep is pretty popular where I am. There's Ram vehicles. Sure, you see a Maserati or an Alfa Romeo every once in a while, maybe even a Fiat, but those aren't real popular vehicles here. But this is 16 different brands under one company. That means you have to design 16 different vehicles. You don't have a platform that goes across all of these vehicles. This is what automakers are moving to now, is a platform where you're just going to put a different shell on top of it. One is going to be a truck, one's going to be an SUV, one's going to be a car. But what undergirds the vehicle itself, the batteries, especially as we move to electric vehicles, that's where the platforms are really being built. That's going to be the same. The software is going to be effectively the same. You can't really do that when you have all of these different name brands. And that's really the core problem, is they're trying to do too many things at once. This is a company that was just shoved together through a bunch of acquisitions and mergers, and it doesn't really make any sense. The business itself is not built to be operationally efficient. And so if you want to go back to what's the core problem, that's it. That's the core problem. GM, who is arguably doing the best out of all of these manufacturers right now, is simplifying its business. It's using the same EV platform for multiple vehicles. It's reducing the number of SKUs. It's reducing the number of parts. You can't do that if you're Stellantis and you have all these things going on. Not to mention, you have a lot more exposure to Europe, where there's much more competition from Chinese automakers than there is in the US. This is why companies like General Motors have gotten out of the European market. So a lot of things going wrong for Stellantis, and that's why we see the stock move lower, and that's why we see the CEO be pushed out like we saw earlier today. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So what should we learn about this as investors? And I think this is really one of those learning moments, especially if you're new to the auto business. I don't think there's any reason to try to bet on a recovery in Stellantis. This is a company that just has too many structural problems to try to figure out whether they're going to be able to turn things around or not. Maybe they do, maybe they don't, but I've outlined why this is going to be such a tough turnaround story. I think what we need to see here is, where is the industry going and who is actually going to be able to make that transition? Obviously, you have Tesla as a leader in electric vehicles. I think they're in an interesting spot because they haven't made a lot of changes over the last few years. The Model 3 and Model Y were the last mass market models that they introduced. Of course, they have the Cybertruck, but that's not going to be a high volume vehicle. So you have kind of an aging fleet there, and we don't know when we're going to get something else coming from them. But they are built to be more of a platform company than most of their traditional automakers. Chinese automakers, they don't own, a lot of them don't even own manufacturing capacity. They're outsourcing manufacturing. They're more design and software houses. So that's much more of a technology play. It's much more the way that Apple makes products, now moving into something like the auto industry. You have most of your other companies kind of stuck in the middle. Ford, General Motors would be in that camp. I think what separates GM is that they have the biggest market share of trucks, large trucks in particular, and SUVs in particular. Again, large SUVs. That's where most of the money is made in the United States. And most of that money isn't made on the coast. So this is where I think a lot of investors get really confused about General Motors. How are they doing so well when Tesla is taking market share? Well, if you're living in New York or you're living in California, you probably don't see everybody driving a Chevy truck. I am in the Midwest. There are tons of trucks and SUVs here. GM is doing extremely well. And we can see that just driving around the street. But it's not something that you necessarily see everywhere. So that's where the cash flow comes from. But then who's going to be able to make that transition to electric vehicles? Those platforms that I talked about earlier. Ford is trying, but Ford has lost a ton of money in their electric vehicle business. Again, I think GM is the more efficiently run company. They've had issues with their software. They're making some changes with their battery supply, but they have really nicely designed vehicles. They're looking at this as more of a platform. They want their suppliers to be much more modular. I think the way that they're building the business, even for this EV future and this software-enabled future, makes much more sense. And part of it is that they only have 4 brands that they have to deal with. Chevy, GM, Cadillac, and there's a lot of crossover between those vehicles, and then Buick. So that's why I think GM is still the cream of the crop, plays out in the numbers, plays out in their cash flow, the buybacks that they have going on. And they don't have the same margin pressure or sales pressure that you see from Stellantis. Stellantis are just way too complicated of a company. Keep it simple. That's what the future of the auto industry is. That's what I think investors can take away from this. Is Stellantis just had the wrong strategy and the wrong operations for the modern auto industry. But let me know what you think about Stellantis' move and their potential future in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.